The capital asset pricing model has had a fundamental impact on both the theory and practice of finance. What I want to do in this clip is to give you a sense of the intuition behind the model and the importance of the model. Now, the goal of the capital asset pricing model is to provide a measure of expected return for any security. So investors can look at a security and distinguish the security not just by name and other characteristics, but by what you expect to return in terms of percentage change per year, say. Now, in order to do this, we need to link risk to expected return. And we have to link it in a way that will be common in the economy. So the capital asset pricing model serves the role of saying that there's a particular type of risk that is relevant for investors, and there is a reward that is associated to taking this type of risk. So that if you tell me what the risk is for each security, I can tell you what the expected return is for each security. Okay, well, I think the first thing that we should do is to derive the capital asset pricing model. And I'm going to try to do this in words, and in the lecture note there's a derivation, and you can see all of the mathematical details of the derivation. Now, this is no really complicated proof or derivation, and the purpose of this is not to show you that we can prove that the capital asset pricing model works. The purpose of kind of going through the details of the derivation is to obtain an understanding of the basic concept of the capital asset pricing model. And I think it's best to do that with a derivation. So let me go through the sort of proof of the capital asset pricing model that I prefer the most. And this proof is really from some lecture notes of William Sharpe, who is the co-inventor of the capital asset pricing model. And he won the Nobel Prize 3 years ago for this very substantial achievement. So let me go through the sort of intuition and proof that he suggested. And then from there, we're going to backtrack and try to squeeze as much intuition out of this model as is possible. But basically what we want to do is to look at a portfolio. And we're going to assume that it's a diversified portfolio. So it's got many securities in it. We assume that people hold diversified portfolios, and this is a reasonable assumption. Next, what we're going to do is we're going to add an asset to that portfolio. Now, our portfolio, before we add the asset, has got some expected return, and the portfolio has got some variance. We know all the formulas for expected return and variance. Amongst the possible investment vehicles is a risk-free asset. So we could write the expected return on our portfolio as the portfolio expected return plus the equals the risk-free rate plus each weight times the excess returns on each of the individual assets, excess being in excess of the Treasury bill rate. So put this in terms of excess returns. So a Treasury bill is explicitly in the analysis, and we've got the standard formulas for the mean and the expected return of the portfolio. Now, I said that we're going to add an asset to the portfolio. Well, what happens when we add an asset to the portfolio? Now remember, the weights have to sum to 1 always in our portfolio analysis. So what we're going to do is we're going to add a small little bit of this particular asset. Let's call it asset J. And we're going to finance that by a little bit of borrowing at the risk-free rate. So the weight's still sum to 1. And what we're going to do is determine the incremental impact of adding this one security to our portfolio. Now in the lecture note you can see that we go through some calculus to do this, but you think about it a little bit and you don't really need the calculus. What is the incremental impact of adding a little bit of this new asset J? Well, remember we're borrowing to do this, so we're borrowing at the risk-free rate. So the incremental impact is just the expected return on security J minus the risk-free rate. So the expected return is 10%, the risk-free rate is 4%, the incremental impact is 6%. Now that's one part of the analysis, the incremental impact on the expected return. What about the incremental impact on the variance of the portfolio? I mean, we always need both the expected return and the variance. Well, this is a little more complicated, but we could write out the formula for the variance of the portfolio, and we're going to determine what is the incremental impact of adding a little of asset J to our portfolio. So really what we're asking for is what happens when we change the weight in J. And that's the notation WJ usually, and W represents the weight. So we're going to increase the weight a little bit in asset J. And it turns out that the incremental impact of adding a little J to our portfolio is simply the covariance of J with this original portfolio. That's rather interesting because we know that if that covariance is negative, that the incremental impact of adding this security will be to reduce the variance of our overall portfolio. Now, we actually do this. What we can say is that we've derived the incremental impact of adding a little J on expected return, the incremental impact on variance. And now what I want to do is to look at the trade-off between expected return and variance, and think about it a little bit. So let's form a ratio of the extra reward that we're going to get for including J in our portfolio to the extra variance that it's causing, and that's just represented by the covariance of J with our portfolio. Call it portfolio P. Now, suppose we do this analysis with another security. Let's call it security I. And we determine the trade-off between reward and risk for security I also. Now, does it make sense that we would get more reward for risk for security J than security I? And the answer, well, I know the answer in advance. The answer is no. And the reason reaches back to one of the fundamental principles in finance, and that's the principle of no arbitrage. Suppose that I can get an extra 6% per unit of standard deviation that's contributed to the portfolio for asset J, and I could get an extra 8% for the same unit of standard deviation for asset I. Well, who's going to buy J? Like, I is a much better deal. The reward to risk ratio for I is much more favorable than the reward to risk ratio for J. So what's going to happen? People are going to buy I, and people aren't going to buy J. when people buy I, it's going to push the price of security I up. What's it going to do to the return that's expected? It's going to lower the return. And for J, it's just the opposite. People are not purchasing J. They're not interested in the 6% per unit of risk. So the price is going to go down. The expected return is going to go up. So in equilibrium, by this principle of no arbitrage, these ratios of reward to risk are going to be equalized. Now let me stop here to emphasize something really important. When I talk about reward, I'm talking about the increment in terms of expected return to the portfolio. And that is just represented by the expected return on the security minus the risk-free rate. When I talk about risk here, I am not talking about the variance or the standard deviation of security I or the variance or standard deviation of security J. That is not the risk in this context. The risk in this context is the contribution of security J to the variance of this larger portfolio, this larger, well-diversified portfolio. And that is represented by the covariance of J and portfolio P. So when I say reward to risk, I mean risk in the context of what this security delivers for the portfolio, what it does to the portfolio, not what it does if you held that security naked. You held it just one security, no other securities. We assume investors don't do that. We assume investors have diversified portfolios. Hence, the relevant measure of risk is the contribution of the security to the variance of this larger, well-diversified portfolio. That's what people care about. So when I say that the reward to risks are equalized by no arbitrage, I mean risk in the context of this well-diversified portfolio. So basically what we're getting here is that the expected excess return divided by the covariance of any security and portfolio P must be equal by the principle of no arbitrage. And from that, it's really a simple step to the asset pricing relation. So you can think of us as having the ratio of the expected excess return on J divided by the covariance of J and P. And that must equal the expected excess return on any security or any portfolio even, divided by the covariance of that security or portfolio with the well-diversified portfolio that we start with. Now the trick in actually deriving the capital asset pricing model is to show that if the reward to risk is equalized in the economy, it's true for not just any security, it's also true for any portfolio. So it's also true for our initial portfolio. Our initial portfolio, which I denoted as P. Its ratio of expected return to risk must be identical to security J's expected return in excess of the treasury bill divided by its risk. Now for security J, we know what the risk is. The risk is the covariance with portfolio P. For portfolio P, what is the risk? Well, portfolio P is a well-diversified portfolio. Its risk is its variance. Just mathematically, you could call this the covariance of portfolio P with portfolio P, but that is simply its variance. So the risk of this large diversified portfolio is simply its variance. So, and this is maybe a little much to do in our head, but we've got a situation where we've got the expected excess return on J divided by the covariance of J and P is exactly equal to the expected excess return on portfolio P divided by the variance of P. When we do some manipulation, we're going to get the relation that characterizes the capital asset pricing model. By simple cross multiplication, we get that the expected excess return on security J equals the covariance of J and P divided by the variance of P, and that ratio multiplied by the expected excess return on P. Now, in equilibrium, P is going to be a very special portfolio. And from what we learned in terms of the efficient frontier and the minimum variance analysis, when we've got a risk-free rate, there's one special portfolio that is optimal. There's one portfolio of risky assets that's the tangency portfolio. And in the economy, there'll be people that will be borrowing to buy that special portfolio. There'll be people that take some of their money, invest in the risk-free, and invest the rest in this portfolio. But in the economy or the world, the lenders and the borrowers must cancel out, and we're left with this one portfolio of risky assets. And that's going to be our portfolio P. It's going to be a well-diversified market portfolio. So in equilibrium, people are levering this portfolio up and down. The relevant measure of risk is the contribution of a security to the variance of this one particular portfolio, this so-called market portfolio. This is the essence of the capital asset pricing model. And sometimes it's written as the expected excess return for security J equals the beta of J multiplied by the expected excess return on portfolio P, which we might as well call the market portfolio. And what does this mean? Well, the beta is simply the ratio of the covariance of J to the variance of this well-diversified portfolio. And it's a short notation for the capital asset pricing model. The beta is a measure that's widely quoted, and in financial analysis you'll see the beta. It tells us something about how the security interacts with this well-diversified market portfolio. If the beta equals 1, then the security moves on average in excess of the treasury bill, very much like the diversified market portfolio. And the key is on average here. So if the market excess return is 10%, then the excess return on security J might be 12%. If the market excess return is let's say 20%, then the excess return on security J is maybe 16%. And when we average this all together, we get an approximate 1-to-1 relation in terms of returns. And that's what a beta of 1 means. When the beta is greater than 1, it means that the swings in the security are greater than the swings in the market measured on excess return basis. And when the beta is negative, we know that this means that the security moves against the market on average. Okay, it's key that you remember this is only on average. If you have a security with a beta of 1, just because the market goes up by 15% does not guarantee that your security will go up by 15%. If we have a number of returns in the market of 15%, then on average, when we look at all the realizations of the excess returns on security J, they will look like 15%. That's what a beta of 1 means. So the beta is a summary measure. It tells us something about the risk of the security. So the capital asset pricing model fulfills this role of delivering a risk measure, which is going to be the beta, and it also delivers the so-called reward for risk, or the risk premium. And that's simply going to be the excess return on the well-diversified market portfolio. So now what we can do, we've got the tools now, where we can actually go security by security, and we can measure the beta of the security. And there's a common measure, which is the premium for beta, or the reward for beta. We take the beta, and alone the beta measure doesn't mean anything. So I could say the beta is 2.5 for this security and 0.5 for another security. That doesn't tell me anything about what the expected excess return should be on security that I'm looking at, whether it has a beta of 2.5 or 0.5. The beta alone is not sufficient. The beta alone is not the capital asset pricing model. The capital asset pricing model is where you mesh together a beta and a market-wide reward for beta. The risk premium is the thing that transforms the beta into units of expected excess returns. And that's something that means something to me. So I can take the beta of 2.5, for example, and if the expected excess return on the market is 10%, then I know that the expected excess return on this particular security should be 25%. So the beta delivers a way to translate just the regular characteristics of a stock or some other asset into something that we call a risk measure, a beta, sometimes called an exposure, sometimes called a sensitivity. And then the capital asset pricing model attaches a premium for beta and delivers an expected return. This is the essence of the capital asset pricing model. The model itself has had a fundamental impact on how finance is actually practiced. It delivers a way to assess expected returns in a very clean, mathematical way that is also rich in intuition.